Hi, hello, and welcome to Journey Towards Wealth. In today's video, we will be discussing about a very interesting and important topic, which is why is it important to start investing early? Many people are ignorant of the fact that when you keep an investment over a period of time, naturally it tends to grow over a period of time. Especially if you are somebody who is investing in stock market, you would be completely aware about power of compounding. Power of compounding is nothing but you are just compounding the effect of the returns over a period of time. Say, for example, if you are investing 10,000 rupees yearly, and next year the value of the 10,000 becomes 10% more, which is it becomes 11,000. And the year after, the compounding happens on 11,000 and not 10,000, which is 10% of 11,000 will be additionally added to 11,000. That is exactly the power of compounding. Power of compounding initially will be a very slow process where you do not see much of a change happening, but it is over a period of time, especially after a period of 15 to 20 years is when you really see the power of compounding making effect, because that is when it is higher amounts coming up with the initial power of compounding. Now let's see that through a simple example over a period of 40 years. This is a very simple example where you are assuming that you are investing 10,000 rupees and you're getting a rate of return of 10%. Now, in this example, what you can see is the value of the money is growing at a very small pace initially. It becomes 10,000, and then 10% added to it become 11,000. Then another 10% becomes 12,100. The pace is not very much high in the initial phase. But if you start looking at it after the year 20, then you suddenly start realizing that the value just keeps compounding at a much higher pace because of the higher base effect, or the base amount gets bigger and bigger over a period of time. This is a simple effect of the power of compounding. Most people ignore the importance of power of compounding over a longer period. People want to get rich just with some quick rich scheme or some easier ways. But the real power of growing money is in the power of compounding, which will start showing you effect over a period of time. For most common people, which is the 99% of the population, this is the easiest way for your money to grow. With internet being so prevalent and information available across, people get attached to the fact that you can get rich by trading in F&O or in some penny stocks. But the real value of money or the growth of money happens over a period of time through the power of compounding. Now, 10% is the minimum that you can expect from the stock markets investing in Nifty 50 companies. The Nifty has given around 12% returns over a period of a long term. Here, the important factor is to stay invested over a long term, whether the market goes up, it falls, it has sideways movement. But over long term, for a period of more than 7 years, market has always given a good double digit returns. And this you can achieve even by investing in good quality mutual funds without taking the effort of directly involving in stock investments. Stock investments are risky, especially if you're not aware about the volatility of the market and the sudden changes that can happen to the moods of the market. So, if you are comfortable with stock market and ready to invest in good quality mutual funds, over a period of time, there is nothing that will stop you from accumulating wealth. Here, the main point is good quality investment and also a longer time horizon. This is a simple success mantra to accumulate wealth over a period of time. When it comes to creating wealth, there are three pillars for it. First is to start early. That is, As early as you get a job, or even before the time you start getting little bit of pocket money or smaller amounts, start investing early. It doesn't matter whether you're investing 50 rupees or 100 rupees, but start investing as early as possible, because the longer the time period for you to keep investing, better will be the power of compounding, and that will start working in your favor, which will help you to accumulate wealth over a period of time. What happens is many people do not start investing early because they say we have a less salary, we do not have enough money to invest, we may have only 500 rupees or 1000 rupees at the end of the month, and we cannot keep investing. But it is okay to start investing even with 500 rupees per month, because it is the longevity of your investment that matters and not the amount that you invest. Then over a period of time you can keep increasing the amount, but you need to start somewhere so that power of compounding can work in your favor. So the first and foremost pillar, or the most important pillar for you to create wealth over a period of time, is through the simple fact that you have to start investing as early as possible. The saddest fact is this part is ignored by most people. They don't realize the importance of starting early when it comes to investment. So, if you're somebody who is keen on creating wealth over a period of time and not looking for quick rich schemes, then starting early is your best option for growing your wealth over a period of time. So, the next pillar when it comes for creating wealth is to invest wisely and judiciously. This has two parts to it. The first and foremost is you cannot get rich on a shorter time period, which is the truth for 99% of the population. So, if you're somebody who's looking for some quick rich scheme or investment to get you wealthy in a short time period, then this is not the way to create wealth. The second part of investing wisely and judiciously is to ensure that you are investing in investment options or products that would give you a better rate of return. For example, people know that today the inflation is at its peak, and unless you invest in instruments that can beat inflation, then your money will actually lose its value over a period of time. That is the reason why you should try and invest in options that gives you better returns, like a mutual fund or a small case or a ETF, which would ensure that you get a double digit return over a period of time. Yes, it is a bit riskier compared to safer guaranteed returns of a fixed deposit. But if you're somebody who is looking at creating wealth over a period of time, you cannot ignore having these kind of investments like mutual funds or ETFs or small cases or direct stock investments in your portfolio for your money to grow over a period of time. Now comes the last pillar for your journey towards creating wealth, which is to increase your investment with every increase in your income. This is a point which is ignored by most people. If they start an investment early on in life, they do not increase their investment over a period of time with every increase of their income. And whatever extra money they'll be earning will be directed towards spending. And this is a hindrance for you to actually grow wealth over a period of time. Another thing is, it is important that you keep investing regularly, probably monthly, through a systematic investment plan, so that you can actually average out the volatility in the equity market. The reason why you need to invest regularly is to ensure that you actually iron out all the volatility in the market and you actually average the cost over a period of time, which will ensure you to have a better return on your investment over a period of time. Now, having understood the three pillars of creating wealth, now it becomes important for you to understand where you stand in all this. Having gone through three pillars that are critical for you to accumulate wealth over a period of time, we need to understand the very importance of the first pillar, which is about starting early. Now, this is a case about two individuals, A and B. First is the case of individual A who started investing 1,50,000 much earlier on, that is maybe around his 20s, and he kept on investing only for 10 years. And he will not withdraw the amount, he kept the amount there, which is 1,50,000 for 10 years, which is 15 lakhs. He just invested for 10 years, but around his 20s, and he just kept it there without withdrawing. By the time he reached retirement, by the time he was 60, that amount grew to a whooping 2.02 crores. Whereas there was another person, which is B. He was investing around 1,50,000, but from the time he was 30, basically a 1 decade after A. And he continued investing for 30 years till the time of his retirement, a total of 45 lakhs. In spite of investing 45 lakhs, his corpus grew to only 1.83 crores because of a decade of loss of compounding. This is exactly why it is important for you to start your investment early on. This is just an example for you to understand the importance of starting early on. It is not about how much you invest, but how long your money is kept for growing. That is exactly the power of compounding. Each year that you miss out on your investment, you are losing power of compounding. That is why it is important to start early on for your money to grow over a longer period of time. So now, having gone through the importance of having to start your investment early on, now let's see an example how a delay in investment by a decade will ruin your asset or wealth accumulation. If you start an SIP of 1000 rupees per month and do a step up is nothing but you increase the investment by 10%, which means the first year you invest 1000 rupees and the next year it becomes 1100. And the third year you again increase by another 10%. So basically you are increasing the amount of investment each year by 10%. Now, if you're investing for a tenure of 40 years, then you will be accumulating around 3.18 crores at the end of 40 years with a return of around 12%. Whereas if you delay it by a decade and you start investing at the age of 30, then you will only be able to accumulate 83.38 lakhs instead of 3.18 crores. The difference is huge with a delay of a decade. And when it comes to 25 years of accumulation, the amount again comes down to 41.09 lakhs. So each delay that you make in starting your investment journey is becoming costly for you with the amount of money that you're accumulating. This table is for anybody who thinks that a small investment will not make a difference over a longer period of time. So, if you are doubtful whether 1,000 rupees investment monthly is sufficient for you to actually start making money, then this is an example which is a big eye opener if you believe otherwise. So, however the amount that you can invest, start investing as early as possible so that you can accumulate a good amount of corpus over a period of time. And better thing to it is to actually increase the investment with every increase in your income so that you will be able to accumulate a good amount of corpus. Now, this is a chart which will illustrate that if you want to accumulate an amount of 3 crore over a period of 10 years, 20 years, 25 years, 30 years, 35 years, and 40 years, what is the amount that you need to do as a step up SIP? That is, basically, you will be increasing your SIP every year by 10%. You can actually see the amount of investment that is required when the duration of investment for 40 years and the duration of investment is for 10 years is almost 100 times. This is
the very reason why we need to understand that starting early is the only way for us to accumulate the desired corpus for our goals over a period of time. Here, if you want to accumulate 3 crores in a period of 10 years, that is from your 50 to the time you are 60, then you need to invest 90,000 per month with a step up of another 10%, which is 90,000 per month in the first year, and 99,000 from the second year, and another step up of 10% in third year, and so on. And if you're somebody who doesn't want to do a step up SIP but regular SIP, then you need to look at somewhere around 1,30,000 per month of investment. This is not an easy task. You need to invest heavily so that you will be able to accumulate the same amount in a shorter span of time. Now, if you're looking for somebody who has 40 years for investment, that is, they start at the age of 40 and they want to accumulate the same amount over a period of 40 years, then you need to do a step up SIP of less than 1000 rupees, which is 950 per month is what they will be starting with. And for each year after that, they will increase the monthly investment by 10%. And if they are looking at a SIP, you need to invest only rupees 2550, which is way lesser than the amount needed for a shorter duration. Now, the thing is, when you start off early at the age of 20, most of us don't realize the importance of investment because we do not have mentors who would guide us for where to invest, how to invest, unless you are somebody who is interested to learn it on your own. But at least as soon as you understand the concept of compounding, it should be in your mind to start even with a smaller amount, the amount that you can invest. This chart will clearly make it visible for you the difference of amount that you need to invest over a period of time in case you do not start early. I really hope if you are somebody who haven't started your investment journey yet, this would be an eye opener and you would be in a position to take the right decisions. This is according to a return rate of around 12% annually, which is very much achievable even if you invest in the Nifty 50 companies or mutual funds. And this is not a huge return that you are aiming for. Having gone through why it is important for you to start your investment early, we need to understand that it is about the time in the market which is more important than timing the market. If you are somebody who started with a smaller amount or a very small amount but early on in life, then you are giving a higher chance for your money to accumulate over a period of time. It is important that you start your investment even with a very small amount but as early as possible. If you are in your 30s and 40s and if you have not started your investment journey, it is perfectly fine for you to start on that journey because by now your income would have raised and you would be able to invest a higher amount than when you start off. You will have around 30 or 20 years for the compounding to do its magic for your investment. Yesterday was the best day for you to start your investment. If it has not happened, start it today. Do not wait for tomorrow and delay your investment process. I hope this video is helpful for at least many of you. Please like, share and subscribe to this channel so that it can motivate us to do more such videos. Thank you so much for your time.